So good morning and welcome everyone to BDO's webinar. As you know, for those who have joined us before, this is a webinar designed for professional services firms. My name is Anna Jarrold and I'm a tax partner focusing on advising professional services firms. So for those who don't already know, and we often get people that are surprised about BDO statistics, but we're at the world's 5th largest accounting network. And we provide all sorts of advice, including auditing, advisory and taxation services. And as you can see by the slides, that we're in over 160 countries and have over 110,000 people supporting various services across the globe. There have been long-standing advisors internationally to the sector, and our national professional services team is one of the largest dedicated sector teams within a UK accountancy firm. So through our strong sector focus, if I can get my words out straight. So through our strong sector focus, we work with a full range of different clients, whether they're boutique firms or large international businesses. And we cover all sorts of structures, whether it's international partnerships, privately owned corporates, or listed or private equity-backed businesses. So there's always lots to talk about the sector. And our speakers today are Lewis Howarth and Siobhan Waters, and they both specialise in employment taxes. There's always so much to talk about employment taxes, given we're all people businesses. We also have Daniel Lambert, who specialises in global employer services, and also Louis Keeping, who many of you know is part of our core professional services team. So within the hour we have got with you, we'll be covering all of the hot topics around employment taxes, even some stuff that's really hot off the press from yesterday, I understand. We'll be talking about the salaried members with an update on the blue crest case, and also global mobility trends and issues about working from anywhere, which we know is a real commercial question for businesses. So as always, we're running this webinar live, and so we encourage you to ask questions throughout the whole session using the Q&A feature on your screen. We'll pick up as many as we can of those questions at the end, and if time doesn't permit, we'll pick them up with you directly after the session. So we'll finish within the hour, and then we'll also share our slides and link to the recording within a few days. So that's all the administration over and done with. So now I can start handing over to our speakers. So first up are Lewis and Siobhan to pick up on employment taxes.
Thanks, Anna. Hi, everyone. So I'm going to start off the employment tax section talking about IR35. So JD, if you can please move to the next slide. Great, thank you. So just to give a quick recap of the legislation, the IR35 or the off-payroll labour or worker rules have been in place for a long time. In effect, the legislation is there to ensure that tax is paid fairly where people are in effect working as an employee would, albeit they're operating through a personal service company, so usually a company that they control, one-man bands type company. And when they do that, they typically benefit from certain tax advantages because they can structure how they pay themselves and ultimately generally pay less income tax and pay dividends and the like. Now, historically, the legislation has been it's been on the personal service company to determine whether they are a deemed employee, in which case, if they are, they would have to apply pay-as-you-earn and NIC deductions to payments received for their services. A number of years ago now, HMRC felt there was a lot of non-compliance within with the legislation, so the legislation was revised. With effect from April 2021, the onus for managing compliance with the legislation shifted from the personal service company to the end user of the work or the contractor's services. And the rules apply equally to corporate entities as they do for LLPs, so it's relevant for everyone here. And this has been a fundamental shift and placed a lot more ownership on the end user, the corporations and the LLPs. And yes, it's HMRC think that by shifting it that way, those sorts of organisations are much more likely to be more diligent and comply with the rules. So in terms of timeline, like I say, they've been in place since 6th of April 2021. And so that's 2 full tax years and just a little over halfway through the 3rd tax year of the new rules. The first 12 months the legislation was in effect, HMRC agreed to take a light touch approach to enforcing compliance. So if an organisation could demonstrate that they've taken reasonable care, as they call it, to comply with the legislation, but mistakes were still uncovered as part of a review, which happens, then HMRC would seek settlement of any liability and some interest. But in most cases, they were openly saying that they wouldn't be looking to charge penalties, providing you'd taken reasonable care and steps to comply. Following that 12-month window, it's safe to say HMRC won't be as lenient around penalties. So if errors are uncovered, you're not just settling the liability and the interest, but penalties, they will look to charge them in effect. So it's vital that businesses are on top of compliance. In terms of recent activity, we've seen HMRC starting to issue quite a lot of nudge letters, as they call them, to businesses throughout the UK. Now, they're a little bit of a fishing exercise, these letters. They'll ask lots of general questions. How many employment status assessments have you completed? How many contractors are you engaging? How many do you subject to deductions via payroll? Those sorts of questions. Now, HMRC frame the letters as though they're gathering just general information to understand how businesses are coping with the change in the legislation and to see how they might be able to improve their guidance and provide more clarity around how to comply. But in effect, it'd be remiss of any business to not be dubious about their intentions and be careful when responding to the question. Now, that's not to say you shouldn't respond, because that's kind of an immediate red flag to HMRC, but to just be mindful that if you provide answers to the questions, they're going to scrutinise them, and if they don't like the look of the answers or things don't align to what they'd expect to see, then you can probably expect some form of compliance review around your policies and processes. So just something to be mindful of. Like I say, we're seeing more and more of those nudge letters. One point of interest, very, very recent, is that where you are settling income tax for an employee, for instance, there is legislation in place that if that employee has settled tax via their personal tax return that should have been withheld by an employer under pay as you earn, then you can receive an offset for what the individual's paid separately. Now, at the minute, there is no corresponding legislation where a PSC has already paid tax, which is then later deemed to have been caught by the IR35 rules, and HMRC would then come to the corporate to settle that liability. Now, from within the industry, we've all kind of flagged this to HMRC and policy to say it's not fair. There's not an alignment across the taxes. So what's happened is a consultation went live a few months ago now, and responses were submitted. And from that, HMRC are looking into it with policy to try and align to allow an offset where the PSC may have already paid taxes. Now, it's not as straightforward as it seems, because a PSC will often pay corporate tax, maybe dividend tax, a little bit of income tax. And if it is caught by the rules, then it would be fully subject to income tax. So how it will work, not quite sure right now. But we are expecting a change to legislation. And in the meantime, while that consultation kind of being, responses have been submitted, but whilst it's being considered by HMRC and policy, HMRC have committed to putting on hold any existing compliance reviews they have, just to allow this change maybe to come in force, so that an offsets can be given if needed. So something just to be mindful of. But they could still start new compliance reviews. And again, when it comes to settlement stage, if issues are found, then that might just be slowed down a little bit whilst this potential change to legislation comes into effect. Also, in terms of since the rules have come in, many of you may be familiar with HMRC's CES tool, so check employment status for taxation tool, which is a way that you can determine the employment status of a contractor. Many businesses use this tool. Now, not to say that the tool is perfect. It's created by HMRC, so some people may think, well, it's probably going to be decided more to a favourable outcome for them of employment. What we actually found is, in large cases, the results of using that tool are inconclusive outcomes, whether someone's employed or self-employed. Not something that's very helpful in most cases, and it just puts the onus back on the organisation to find the right conclusion and proceed with that engagement. Now, what HMRC have done in the last couple of months is they've improved their CEST tool, I would say. So they have made it. They basically updated it so that as you answer questions within the CEST tool, you can see you can check your answers at each stage rather than just at the end, and make sure that you're happy that you've got the right answers provided. They also provide links to their guidance, which helps you understand the sorts of questions they're asking and how to then therefore answer the questions correctly. And then at the end, when you get your conclusion, they also highlight the key reasons why that conclusion has been reached. Previously, they didn't give you any further information. They just said it's employed, self-employed, or inconclusive. So it gives you a little bit more information. So I think it's a step in the right direction. It's not to say the CES tool is perfect still, but just something to bear in mind of how they are adapting since the rules came in place.
Yeah.
So with the rules, who does it impact? As you can see on that slide, I've referenced a few different departments. In effect, when I've had conversations with clients around the rules, talking to at least maybe 2 of those departments, sometimes all of them. But ultimately, if you get this wrong, it can impact the whole business. So why do I say that? Well, contractors are a vital part of the workforce. They allow businesses to have that ad hoc workforce, often specialists as well, to come in and do one-off projects. Some businesses, when the rules first came in, took a very hardline approach and were saying, we're not going to employ any contractors on a self-employed basis. Automatically, we're going to hire them on an employed basis subject to pay as you earn and NIC. So they're not employees, but they're deemed employees under the rules. Now, in effect, many organisations have stepped back from that approach because they realised it put them at a commercial disadvantage because they weren't able to attract that workforce as and when they needed. So, like I say, if you take a hardline approach, it can impact the whole business commercially. So it's just about being careful of what steps you take and being mindful that if you are having discussions around what policies and processes would be in place, tax, finance, payroll, HR, procurement, which should probably all be involved in them initial conversations. Really important. In terms of some of the risks we're seeing, so many businesses have statements of work for services. There was a big shift when the rules came in to put statements of work in place because a statement of work is effectively procurement of a service rather than labour. And the IR35 rules are looking at those labour type arrangements. But in effect, HMRC will look beyond the contract to understand what's actually happening on the ground. And if they consider that actually you're just procuring a labour, a person, rather than a composite kind of outsourced service, then they will say that the rules should be considered in more detail. And it's a big risk for lots of businesses. Lots of businesses think, oh, we've got SOWs, we can forget about it, we don't need to comply. But it's not quite the case. So often reviews need to be completed there. Understanding where your contractors are. It's surprising how many conversations I've had with businesses and they have no idea how many contractors are in the business and who's hiring them within the business. So it can be quite a big project initially to understand who's already in the business, to understand where you might already have risk, but also where are they coming into the business so that you can kind of get ahead of it, of new contractors coming into the business and make sure that you're complying with the legislation. Often work can be done to review your supplier data on the GL to identify those workers, but it's not always as straightforward as it seems. Understanding employment status, so particularly when you're doing this using the CEST tool, which I mentioned earlier, having a good understanding of employment status is really important to make sure you're answering the questions correctly. HMRC will stand behind the answers, the output of CEST if you've answered the questions correctly. But if you don't understand how to answer the questions in the first place, then you're always going to be at risk. And then tracking and monitoring is key. Tracking throughout the life cycle of that contractor being within the business, understanding whether there's any changes in the work they're doing or the contractual arrangements, and doing a re-evaluation of their IR35 position at that stage, really important. And periodic checks of your policies and process to make sure they're being followed and are up to date with the legislation. Now, so areas of focus, payroll compliance. So many businesses, if they have deemed employees within the business, how is withholding taking place? If you are the business that are paying the PSC, then that's with you. How do you handle that basically? If it's an agency in the chain and they are the fee payer to the PSC, then again, are you making sure that they are subjecting the payment to pay as you earn and NIC? Having policies and processes, many businesses still don't. They have like they have an informal policy in place and process in place that's discussed between the business, but nothing's documented. HMRC do a review, they're going to want to see what your policies and processes are, so they'll expect them to be documented. And then, the CES tool again, just making sure that you're using it correctly and whether actually it's the right tool for your business. If there are other tools out there on the market, but it's just understanding, is that the right way forward for you as a business?
Yeah, and Lewis, just in terms of how businesses are already reacting to this, because as you say, it's been in for a little while.
Yeah.
How have people in the clients that you have been advising responded to this? How are they
It's
managing the compliance?
Yeah, it's been a really mixed bag. So I think we've seen very large organisations, and it's worth mentioning that the I-35 rules in their current format apply to medium and large organisations, and there's a balance sheet turnover and employee headcount test to look at there. But for your really large corporate entities, they kind of saw them get on top of it right away, but they've got bigger budgets, bigger teams to help manage some of these processes. Um, Beyond that, it's been a real mixed bag. Some companies really concerned about it. Some companies, yeah, we kind of looked at it. We don't think it's too much of a risk, but they're not really sure. So, and lots of companies receiving nudge letters and being like, oh, maybe we actually now need to do something. So it's been interesting because I think generally we're like, well, it's a legal tax requirement to meet this, and some businesses have just been like, it feels too hard work. So
Mm.
yeah, it's been a real mixed bag. There is a lot of risk out there, and obviously we'd always encourage businesses to really make sure they're clear where their contractors are and then whether they need to do anything.
Yeah, and of course, once you've got that nudge letter, it's a bit late then.
Exactly.
You
Yeah.
know, I know it's never too late, but it is a bit late to protect yourself fully. So, understood. Thank you.
Great. So I'm going to move on to just labour supply more generally. Jade, if we could please just jump to the next slide. Thank you very much. Now, we just want to talk a bit more broadly around your labour supply chain. Now, this includes your contractors coming into the business, but it's much broader. It can involve where you use it. You've got a service of employment agencies to provide workers from time to time, temporary staff maybe. You engage or you have the service of an umbrella company to operate payroll withholding, and agency staff and the like. Now, HMRC have been much more vocal over the last few years to make sure that businesses are looking at their wider supply chain to ensure that correct due diligence is happening. And there's two risks here. There's a tax risk potentially, but there's also the legal risk as well if you're not doing this correctly. Now, when I talk about legal risk, I'm kind of thinking about the corporate criminal offence legislation, which has been in place for a few years now, very widely drawn in its scope, and it's not been fully tested. But effectively, the legislation suggests that you should have suitable prevention measures in place to make sure that there's no criminal actions happening in your supply chain. Now, it's very difficult to prove criminality, but it includes to make sure that you're covered. You should be regularly checking and monitoring who you're engaging and ensuring that they're legitimate, your suppliers. So, what does good look like? You want to be kind of identifying the labour entering the business, understanding who's joining the business, the people that are running the agencies or the employment agencies, as it may be. Or have you identified them? Do they look like they have the requisite skills in place? And does the business look legitimate? And just continuing to monitor over those organisations whilst you're engaged with them. Do they have suitable accreditations? There's organisations like the FCSA and Professional Passport that labour supply chain providers can get evidence from that legitimise their business. But we'd still encourage businesses to complete their own due diligence when utilising kind of labour supply chains. But then it's much broader. So if you are using these sorts of organisations, labour providers, how do they pay the workers ultimately? So you may pay them to then pay the worker, but do you have an understanding of how they operate? Do they operate any unusual payment structures that you wouldn't expect? You would expect payments to be subject to pay as you earn a NIC, and that's about it. But it's just having a good understanding of what they're doing as a business. With the CCO legislation, there's potential to receive unlimited fines, and then beyond that, you've got probably in many ways much more significant reputational damage, and whether you may have to disclose anything to a professional body, thinking like law firms in particular. So it's just something to be mindful of. Like I said, the CCO legislation is very it's still fairly new and untested in how far reaching it is, but it's something to have on your radar and something that HMRC expects every corporate and in the supply chain to be looking at. Just by way of a case study, a few years ago now, and there's lots of this, and there was lots of articles on Google you can find around mini umbrella companies. This was an area where the labour supply chain due diligence wasn't good enough for many organisations. In effect, you had lots of people incorporating a company in the UK to offer umbrella company services. Within a couple of months, maybe a month of that incorporation, directorship changing, name changes, quite a lot of that. And what happened actually was the directors were in the Philippines, and in effect, it was somebody who'd been paid a fee just to be a named director for this company. And in effect, these mini umbrella companies, as they're referred to, were small companies that would be able to benefit from the employment allowance for NIC and flat rate schemes for that. And effectively, were set up purely to maximise all these sorts of tax advantages for small companies to save money. Then they often get quickly wound up, and sometimes unscrupulous kind of payment structures were in place for the workers as well. And then the company would get wound up and the worker would be left maybe without full pay. But lots of companies were engaging with these mini umbrella companies without realising the actual structures. And again, it comes down to just having appropriate due diligence in place. So we'd always, like I say, highly recommend that you are checking who you're engaging with and their structures and who's running the companies and whether they have the requisite skills and where they're based. That's just a small example of where things have gone wrong previously. I'm going to pass over to Siobhan now, who's going to talk to you about NMW.
Thanks, Liz. Hi, so today I thought it would be good to give an update on some of the current HMRC activity that we are seeing with an investment into the resource at HMRC. It seems that they are using that to expand, and we're seeing a lot more activity coming out of the National Minimum Wage team. So just to go over some of these which may bring private services into question. So geographic targeting is a new approach that we have seen HMRC use just over the last year. It works through many phases. So they target a particular geographical area, send out numbers of letters with some checklists on it. Again, the nudge letters coming into play, invite employers into doing a health check. And then there's some follow-up inquiries as a result of this activity as well. What also goes alongside this is they're targeting workers in the same area as well, giving them an overview of the risks that they could be facing within their employment and how to raise a complaint to HMRC. We're also seeing a lot more work coming out of their specialist enforcement teams. Now, these are teams that tend to deal with the more large and complex businesses, so moving away from some of the smaller employers and some of the kind of high street employers, which would normally be a traditional target for national minimum wage non-compliance. They've conducted a programme of work doing repeat visits. So this is people they've previously visited, they've left them with, information on how to ensure future compliance. They're now going back out and checking that has remained in place and that people have made any adjustments according to any legislative changes that have been out as well. We have always seen them do sector targeting, so they'll pick a particular sector, and for the few years that had been very successful, it was within the same type of sector. So, what they would have classed as their bread and butter cases. We are now seeing that move more into much broader sectors and sectors that might feel traditionally more away from paying national minimum wage rates. We've seen motor retail being the latest sector that they've sent the nudge letters to, but that motor retail sector also included the motor finance as well. So it's much broader than just a small sector they're looking at. And one of the key requirements that the Low Pay Commission, who informed policy in national minimum wage, asked was to increase the awareness for workers. So I mentioned, they're looking at the geographic section where they're sending out letters to workers. They are doing that in each sector that they're doing. They're sending that out en masse. We are aware that they're sending that to workers that are earning up to £33,000. And the key thing about that is HMRC are obliged to investigate any complaint if they believe there's merit in that. So whilst professional services might feel that they have salaries that are way above national minimum wage and the risk could be minimal, you might have one or two people that could be within a workforce that are at the lower end of the scale and fall under that 33,000 bracket. If one of them does make a complaint, it can open up an inquiry, not just in that individual, but across the whole business and potentially the whole group. And we have seen that happen in a number of cases as well. Okay, next slide, please. So I mentioned the legislative changes. So there were changes from salaried hours in April 2020. Now, there was a transition period up until 2022, and now HMRC have started doing some webinars themselves advising on this, and we know that their webinars advising often follow up with activity, and we are starting to see some of these being challenged in some of our clients as well. So there was some conditions that had to be met before April 2020, and there's some conditions that are now having to be met after 2020, and that is around how you classify your worker. So there's 4 worker types for national minimum wage purposes, and a salaried worker is one of them. I won't go through all of this in detail because I'll take up all of the webinar, but if I can go into the next slide, I'll give a bit of an overview on why salaried workers is not just as simple as paying someone an annual salary. So apologies that this is quite small probably on your screen, but one of the things that HMRC will use to establish if a worker is salaried is that they're paid an annual salary and or a performance bonus or salary premium from the 6th of April 2020. So it might be the case that people could have reclassified their worker types due to the legislation changes. It then goes on to say that, do you provide a basic number of hours per year, or are the basic hours per year ascertainable? I have never seen a contract that gives annual hours in it. It's not something that's standard, but the ascertainable part is key in this. So if an employer doesn't have annual hours in the contract, how would they ascertain what the annual hours would be? And then it moves on to the only payment workers entitled to, and is the worker paid in equal instalments? So you can see there it branches off into many different things, and getting one section of that out of sync would mean that you couldn't classify them as a salaried worker. If I can just go on to the next slide, please. So one of the things that we are seeing as a bit of a weakness on this is the formula that's being used to create the annual hours. It has to be the full calendar year. Now, there is no confirmed methodology that HMRC advise people to use on this, but what I do see quite a lot is them challenging when people use 52 weeks, and then I have to explain to people that there's not 52 weeks in a year, which seems really bizarre, but most people, you know, take that at face value and let me explain it, but it only covers 364 days if you use 52. So there are some considerations to think about how you would look at ascertaining someone's hours if your payroll and your structure was set up as a 52-week calculation. If we can just go on to the next slide, please. And where that comes into play is that if you have got a salaried worker where you have ascertained their hours and it only covers 364 days, there is a risk that you could be underpaying them for that last day of the year, or this, if it's a leap year, obviously the 2 days. And there's a calculation that has to be conducted to ensure that over a calculation year, your workers, regardless of their rate of pay, regardless of the salary, that they are not breaching excess hours, because the key compliance part on this is that you need to pay the minimum wage, or at least the minimum wage for their age, for the period that they would be breached the excess hours for their annual contract, as well as the hours that they pay. So quick example there, if the calculation year runs and they breach their hours in February, you have to pay them what they're entitled to in March, as well as the hours that they work in March as well. So this is quite a big admin piece of work that a lot of people are finding that they're having to look at and review, and make sure that when they're calculating the annual hours and any excess hours, that they're doing it in a way that doesn't disadvantage them and leave them with multiple large payments at the end of their calculation year. I think with this as well, national minimum wage, a lot of people say to me, you know, I pay the real living wage, or we pay well above what the published rates are. So, you know, it's not the compliance part of it's not an issue for us. I think what we have to think about with this is it runs much deeper than the rate of pay. It's about how the calculation is done. There are so many complexities to that. There's so many different factors and things that can be included and aren't included. And if it's not already part of pay governance conversations, it certainly should be something that would be on a regular review. Again, policies and processes being key in any activity that HMRC look at. Lewis, I think I'm handing over to you now for another part.
Thanks, Siobhan. I'm going to keep this really quick because I'm conscious of time, but we just wanted to give a quick overview on payroll governance. So I've got some statistics there, HMRC statistics, that 788 billion of tax revenue collected in 22-23, and you can see the numbers there of how much of that relates to pay-as-you-earn and NIC through payroll and the app levy. So big numbers, significant, the biggest portion overall. So if you have an issue around your payroll, that can scale up really quickly. A couple of insights is tax authorities, HMRC and overseas authorities, increasingly data-driven and using software to analyse that data. So they are much more responsive and quicker to identify issues. Key for payroll, I mean, inputs as much as your outputs, but yeah, you can have a great processing system, but it's only as good as what's put into it. So it's really key that you've checked all the errors and make sure that everything's being captured, particularly for an MW, which Siobhan just talked about. And then with your outputs, does it give you enough detail to check and spot errors? Technology around payroll is becoming increasingly important. Using API to connect your different systems, HR systems, say the likes of Workday, and connecting up to your payroll system, remove that manual side of transferring data. And then if you are within the kind of the SAO, Senior Accounting Officer rules, then again, you will be expected to have good policies and guidelines around your payroll structure and suitable people with the right qualifications looking after them to make sure that you've got the right processes in place. And then where things can fall apart, you might have good governance, and you merge or acquire another business into the business. Can be a messy step to complete and has some important legal steps as much as tax steps to consider. But it's just really important that you kind of you think about how that's going to take place to make sure it's effective and forms part of your future overall kind of payroll governance process. So I'll leave it there for now. Apologies, that was a bit quick, and I'll hand over.
Thank you, Lewis. And if we've got time at the end, then obviously we can pick up on some questions on that as well. So thank you to both there for Siobhan and Lewis. Now we're going to pick up with Louis. So Louis is going to talk a bit about the Blue Crest case, what it means to those LLPs out there. It's good to get some updates on this new-ish legislation and some clarity on some of the things. So Louis, over to you.
Thank you. So I think, as Anna mentioned at the beginning, I'm by no means an employment tax specialist. My background focuses on professional partnerships, but I've joined in speaking at today's webinar just because it's probably a good forum to provide an update on the recent upper tier decision on the Blue Crest case, which was in September this year. So we can go to the next slide, please, Jade. So maybe just as a reminder of the salaried member rules very quickly. Introduced in 2014, and they were to deal with the disguised employment of members of the LLPs. So under salaried members rules, members of an LLP can be treated as employees for tax purposes if all three conditions A, B, and C are met. Condition A being disguised salary, which broadly speaking will be met if it's reasonable to expect that at least 80% of the total amount payable by the LLP under relevant arrangements is in respect of the member's performance during the period of services will be disguised salary. Condition B will be met if the member does not have significant influence over the affairs of the LLP under the mutual rights and duties of the LLP and of the LLP and its members. This one's quite topical in the Blue Crest case that I'm going to come on to in a minute. And condition C will be met if the member's capital contribution to the LLP is less than 25% of their disguised salary in the tax year under review. So the Blue Crest case is one of the first cases that's been taken to the upper tribunal in respect to the salaried members rules. And so for us, it's useful when considering these rules and gives us a bit of a precedent to look at. So in terms of the facts of the Blue case, of the Blue Crest case, just to recap. Blue Crest Capital Management UK LLP provides investment management services as a sub-manager to the Blue Crest Group and their funds, and also provides some support services to the group entities such as legal, finance, and IT, that kind of thing. Members can be categorised in two ways: either portfolio managers who are responsible for managing their investment portfolio, and may also be desk heads responsible for overseeing a team of portfolio managers. And the others are non-portfolio members. So that comprises all other members, which includes those providing back office, support services, etc. So in the period under concern with HMRC, there were about 80 members in total. Over half of those were portfolio managers. So the application of conditions A and B of the salaried members rules to both the portfolio managers and non-portfolio members was in point and subject to challenge from HMRC. It was common ground that condition C was met. So a bit of background of the case for condition A in Blue Crest, the disguised salary. For portfolio managers, they were entitled to their priority distribution of 150,000, which was agreed to be disguised salary. They also entitled to a discretionary allocation, which was calculated by reference to the profit on their individual portfolio. And the question here was whether this is disguised salary or not being subject to the appeal. And an income points allocation, which was agreed not to be disguised salary. But in this case, it was quite small, so largely irrelevant to the purpose of the condition here. For non-portfolio members, i.e. those who are doing the back office work and support, the remuneration was not calculated based on their individual profits and loss, but discretionary allocations took into account a number of factors, including roles, duties, individual performance, market rates, etc. Moving on to condition B, which is probably the more interesting one for us in this case, and significant influence. So Blue Crest recruits portfolio managers from other firms as well as growing its own. So the junior portfolio managers wouldn't be partners until they showed themselves as being capable of filling a partner's role. Then they'd be given a capital allocation of around $100 million. Lateral hires would be given the same amount when they join. And the portfolio managers are given their full discretion regarding the positions they take and incur risk with their own strategy, etc. These portfolio managers are involved in hiring new portfolio managers, bringing on junior portfolio managers. They manage relationships with other counterparties, banks, etc., with who they rely on to kind of do their investment portfolios. For the other portion of the members, the non-portfolio members, including department heads of similar seniority, they're responsible for the day-to-day running of the processes which is necessary to support those investment managers, which includes hiring, performance reviews, termination of employees, etc. Now, the LLP agreement for Blue Crest provides for responsibility for the operational management of Blue Crest business to be delegated to an executive UK ExCo, and we see lots of similar references in the professional partnership world. So the first tier tribunal initially ruled that condition A was in HMRC's favour based on those facts we just discussed, and condition B was in Blue Crest's favour in part, just to add in part, not in full. So the reason behind the judge's conclusions for condition A, which was in HMRC's favour on the disguised salary, was that individual members' remuneration need not track the LLP's overall profit or losses, but there must be a concrete link between an individual's remuneration on the one hand, as well as the profits of the firm on the other. So you need to really be looking at the overall profits of the firm and looking at your bonus there. So on the facts, there was no such link that had been evidenced, and the discretionary allocations were more akin, it was decided, to an employee's performance-related bonus than to what a partner in a traditional firm would be sharing in the overall profits of the partnership. So the portfolio managers were not really concerned with if the partners had a great year, provided there was just sufficient profits to cover their individual allocations, and they had no share in the uplift if the LLP performed better, etc. So that's where HMRC landed for the portfolio members. For the non-portfolio members, their discretionary allocations were based on a less formulaic approach, but there was no evidence of this being capable, again, by reference to the variation of profits of the firm. So HMRC were kind of successful at that point stood. More interestingly and relevant, I think, for us from this case was the reasoning behind the judge's conclusions for condition B, which is partly in Blue Crest's favour. And what the comments came out of here was significant influence wasn't restricted to the managerial influence and could also include financial influence. And also, which is interesting, significant influence could be over one or more aspects of the affair of the LLP rather than just its overall affairs. So I think that's relevant for large LLPs in the professional partnership world that we deal with when looking at this condition, if they're looking to rely on this to kind of fail the salaried members test. When referring to the purpose of the legislation as being to distinguish between members, where position is that of a partner in a traditional partnership compared to those who are playing the roles of employees, the judge noted that the role of a partner in a traditional partnership, as we know, is to go out and find work, supervise others to undertake it, and do the work themselves. It's not limited to making management decisions, but effectively to contribute to the whole success of the partnership. So on this basis, in this case, portfolio managers with capital allocations of their 100 million were deemed to have significant influence over the affairs of the LLP. Their financial contribution could be clearly defined by their output, and there was significant evidence as to the operational and management activities that was undertaken by them. They were involved in the activities you'd expect a partner in a traditional partnership to undertake, which is your hiring, your firing, new business opportunities, bringing on junior staff, etc. Where HMRC was successful in their challenge here in terms of the non-portfolio portfolio managers, they decided there was insufficient evidence of them exercising significant influence, whether that be operational or financial. So in respect to their internal contribution, they assisted the portfolio managers to exercise their significant influence, but didn't do so directly. Interestingly as well, this included the UK executive company members, for whom it couldn't be determined how those individuals played a significant part in making the decisions. That was where we got to with the first tier tribunal. The upper tier tribunal decision was released in April, 18th of September, in this year, and it confirmed the first tier tribunal's approach in respect of condition A and B. So whilst the decision on condition A in HMRC's favour is pretty uncontroversial for us, it's kind of as we thought, the decision on condition B kind of broadens the meaning of significant influence over the affairs of the partnership. Beyond what we've seen, the kind of restrictive interpretation taken by HMRC to date. So it's really interesting for us to kind of delve in with our clients to help understand where they are with their rules when considering their position. So we think it's a welcome development for LLPs, with members who kind of sit on the borderline of falling in or out of the rules. The upper tribunal kind of emphasised, though, that the facts of the particular case obviously have to be considered on a case-by-case basis as to whether individuals have significant influence or not. This is just a guiding case for us as a starting point. And we're keen to point out that the evidential burden obviously remains with the taxpayer. And you need to undertake a detailed analysis of whether or not you think the case, if you think the rules apply on a case-by-case basis. So from our thinking, we think LLPs would be well advised to revisit their salaried member analysis just to ensure the status is monitored on an ongoing basis, as I'm sure everyone does anyway. But the Blue Crest decision kind of gives an opportunity to reassess condition B, where you're looking at that as part of your overall position on the salaried members rules. But again, caution should really be considered before making any changes to rely on that. But this is probably just from the first case we've seen coming out.
Yeah. Okay, Louis, thank you very much. Very interesting and particularly difficult when it's all subjective in terms of, what you need to take into account with these things. But
Exactly.
the case does look like it gives people opportunity to fall into that sort of to fall out of the rules effectively. But it also might narrow it slightly as well. So very interesting. Thank you, Louis. Okay, so let's move on to another sort of hot subject where global mobility is coming into everyday lives with professional services firms all the time, with people wanting to work anywhere around the world. So Daniel, handing over to you.
Thank you very much, Anna. So I think probably the best place to start with where we are is actually where we've come from. And I think it's fair to say that there's been a huge change culturally over the past 5 years. We've had COVID, we've had Brexit, there's now a far greater expectation on employers to be demonstrating EDI and ESG values. And all of this has impacted how people work and their expectations of their employers. It's often said our people are our most valuable asset. I think it's probably fair to say that for professional services, that's more true than most. And keeping them happy is now more important than ever. And this is where BDO's Global Employer Services team can help you. So if I could have the next slide, please. So I'm conscious of time. So these are some of the global mobility trends. I'd just like to dip into a few of them that I think are probably most important. I'd say over the past 18 months to 2 years, the biggest change we've seen in global mobility has been the huge increase in remote workers. Obviously, as hybrid working is now more widespread, people don't just think that they can work from home if it suits them. They might think that they could work from another country if it suits them. If this is in fact so widespread that BDO has introduced its own policy where we'll allow people to work for up to 10 days from another country. Has to go through various checks, has to be approved by our head of global mobility, but nevertheless it's there. And from personal experience, I've had a client where they were coming to me asking, we've got someone who wants to work for a month in another country, tag it onto the end of a holiday. What does this mean? Over the course of about 6 months, we had numerous different people asking the question. I think we got up to nearly a dozen countries. In the end, the client decided that they actually wanted to put a policy in place as to how and when and under what circumstances their employees can work remotely, and we were able to help them put that in place. Another big trend, I would say, is the increase in business travelers. I think it's probably fair to say that we've seen a decrease in traditional assignments where people are going for 2 to 5 years to work overseas. It's now much more common to see shorter term, more regular travel to overseas locations. I would say the big takeaway from that is understanding that there is potential for reporting and tax and social security requirements from the first day someone works overseas. In the UK, our PAYE rules are such that if you come to work in the UK for the benefit of a UK company, you have to operate payroll. There are some ways that BDO can help alleviate that with the short-term business visitor agreement, but essentially HMRC's position is you either have a short-term business visitor agreement or you operate payroll, and if you're not doing one of those, then you've got a PAYE failure. So I think for both of those, remote workers, business travelers, the key is making sure you know where your people are at any time, especially if they're working. This is very much an increased area of focus for national revenue authorities. They understand that it is a likely area of non-compliance. I used to have hair, but I pulled so much of it out from receiving calls from people saying, I've just found out so-and-so's been working here for however long. So it does happen a lot. And it is really important that you are able to effectively track your employees as to where they are working. Another one to dip into, I think, is probably talent shortage. Again, I think it's fair to say that there's a far greater focus on people recruiting and retaining staff. I would say an aspect of global mobility is something that can provide an extra incentive to individuals. I dare say that the fact we have a policy on being able to work remotely has come about because we're aware that our competitors will provide it if we don't. And again, from personal experience, I had a client who had an employee that's wife had received a once-in-a-lifetime offer to study in Germany. They really wanted to keep him, and obviously he wanted to be with his wife, so they looked at whether he could work remotely from Germany. They were able to establish that from a business perspective that would work, and as I say, they were very keen to keep him. They came to us. We were able to provide advice on the first 6 months. It then became 12 months. It then became permanent, and we were able to help them at every stage to ensure that the employee and them as an employer were aware of their obligations, what it all meant for everyone, and they were able to keep that employee happy, and it was a great result. One more thing I would like to dip into, and I think in the current environment, it's probably one that a lot of people are aware of. Return on investment and global mobility spend. The reality is that sending people on assignment is not cheap, but at the same time, it doesn't need to be expensive. And if you are able to structure the assignments in a particular way, you can take advantage of numerous tax reliefs that will obviously lower the cost of an assignment. Again, that's something that we can help with. Likewise, for budgeting purposes, cost projections on what an assignment cost might look like. As I say, aware of time, so there are obviously other things that I haven't spoken about. In your own time, when you're able to look at the slides, if there is anything that you would like more information, by all means, please do get in touch and I can provide that. If I could have the next slide, please, Jade. Thank you. So I also wanted to run through some of the implications of having people working from anywhere, specifically with relation to that remote working and business traveler view of what I've just spoken about. So the most important thing I would say is ensuring that whenever you have someone working in a location that they're not normally working in, do they have a legal right to work there? Obviously, we're no longer part of the EU now, so some people perhaps overlook the fact that you can't just go and work in Europe now. You don't have a right to work there. Many other countries, there's visa applications that need to be filled. For example, in the US, if you don't have the correct visa, they can refuse entry. You might get deported. You might be refused entry in the future if you've been caught doing something that you shouldn't be in the US. I know that in Thailand, if you work there without a work visa, you can be imprisoned for up to 5 years. So obviously, huge HR and reputational risks of not having the correct paperwork in place for individuals to work overseas. Income tax liability in the other jurisdiction, that will largely depend on a few things. The typical response I hear from clients is they haven't gone for 6 months, so it's all fine. That's largely true. If there is a double tax agreement between the UK and the country that they're working in, there are some exceptions. The US has state tax as well as federal tax. A lot of the states don't actually recognize the double tax treaties and say, if you're working here, we'll tax you from day one. And it's not the smaller, lesser known states, California, New York, they apply this. Another thing to be aware of is effectively for a lot of countries, the UK included, the double tax agreement that will exempt you from income tax doesn't apply to directors. So in the UK, if you have a non-resident director who is a statutory board member who comes to the UK to perform board duties, they will be taxable here, and you will need to operate payroll if they are doing that. Another issue that people can trip up on is who is the economic employer. If the country in which if there's a recharge to the country where they are working, that country then becomes an economic employer, and that will fail on almost all of the employment treaty exemptions as soon as you have that recharge. Income tax return filing requirements. Again, these don't always follow the tax position. As an example, in India, you might be exempt under their short-term visitor rules, but you will need to file a tax return in order to claim that. So even though there's no tax actually due, you still need to file the tax return to make the claim. If the individual doesn't do that, then it's actually on the employer to operate payroll. So you can see how everyone making sure they understand their obligations is really important. Payroll reporting requirements, again, these typically they will follow the income tax position. They don't always. There's social security implications there. Again, social security could kick in from day one, and obviously that would need to be a payroll issue. So you could have a situation where you need to operate payroll for social security, but not tax. I mentioned earlier the short-term business visitor rules in the UK. Although there's not strictly speaking payroll reporting, you still do need to make reports even if you have that short-term business visitor agreement in place. Permanent establishment risk. Again, depending on what people are doing and what level they are at, this could be a significant risk. If you have people that are able to bind your firm to contracts, then potentially that could create a permanent establishment. Likewise, if you have a director working overseas, that could create a permanent establishment. Those of you with partnerships feeling slightly smug right now, unfortunately, this would also apply to partnerships. If you have a partner with a second home, that the OECD commentary implies that they would view a home office as a place of business, and in which case you could have a permanent establishment. That would have the knock-on effect of all the partners in the partnership having to file in that country.
Very potentially. Daniel, just sorry to interrupt you. It's one of the things that we always say we do is finish within the hour. So what's your last point before we say goodbye to everybody? And we have got a few questions that we will follow up with people after the webinar on.
Yeah. So final one, sensitive information risk. Some countries obviously have very different data protection rules. Being aware of the potential issue for information to be taken from devices. I have a client who says we don't let our employees turn their phone on in a certain country because, quote, they always come back with a virus. I assume they mean the phone in that instance, but I'll leave it there.
So yeah, what a way to end the webinar. Thank you very much. Okay, well, yeah, thank you. And thank you, Daniel and Louis and Siobhan and Lewis, for all of your contributions there. There's obviously a lot going on, and we could talk about this sort of subject for a very long time. As I said, we do have some questions that we will follow up with people that have asked those after the webinar in person. So apologies, we've not got to those within the timescale. Thank you all for listening, and we look forward to seeing you the next time. And we'll be circulating the slides and the recording within a few days. Thank you, everyone.